or at least continue a journey on the field of interest rate risk and long-term funding, because last week we generated a lot of excellent data about what happens with, or what can possibly go wrong with the interest rates. So right now we have a data set which shows us that what can happen with the bond yield this is the expected scenario, under current terms. And we finished here when we were saying that, okay, this can be the possible yields, which will determine obviously the interest rates for the company, because it's easier to calculate this way. Now let's see that what happens if we have to do similar thing, just with first we have to calculate the possible bond yield on profit value, default probability. Can't we combine them? In this case we have just to copy paste one thing and not two. I'm always lazy, but yeah, this is just one figure. So instead of doing this, impact of current and worst case scenarios on bond yield of bond yield on profit value, okay. Then still we have to close down this section, because obviously if you are writing something, then at the end of a section must be something conclusive. So let's say that we can expect that inflation with the decline of the inflation, bond yields will converge to 3.5%. That's a nice expectation. So let's see worst case scenario. So in this scenario we were assuming what? So we were assuming that what happens if we are maximizing not the inflation. Possibly we could say that what happens if inflation stacks at higher levels, but the interest rate level is already quite high, so the yield is good enough. And we are talking about the Eurozone, not some small and open economy where things can go sideways easily. So yeah, so in this case we were assuming that the inflation will follow similar trajectory as it is expected by the ECB. Now let's use a footnote, because we have this fancy website which I'm always forgetting. So let's fix it here. References, insert footnote. There you are. Now it's a link. Oh, we already linked it once, but at least we can say that we are using the same data. Then what is important here, that but for the sovereign premium we used highest values between so we can see that the database started in 2000 and how does it look like? Yeah, this is a weekly data. Okay, so it's or mostly. Yes, it's a mostly. Okay, so just usually I'm downloading quarterly data. That's why I was confused that they are not. But so it's mostly data. So September 2003 until September of 2023. Okay, then yeah, we were not able to grab this kind of data, so due to inavailability, obviously there is a typo in it. Unavailability. Oh, come on. There was no data. Oh, but due to the lack of data for corporate bond risk premiums. The risk premium French government bond and we assume to be the same. While it will be yes, was acquired from the US market, which is not nice, but we needed something, so at least it's not 0 point something anymore, it's 2%, so yeah. Then we will put the table here, and at the end of the day now we can see that under stress levels bond yields can fluctuate around 7% in the medium run. So okay, now we have the worst case scenario. So we can see that depending on the situation, medium run yields can double if things are going sideways, but okay, we can assume that if there is no exceptionally inflationary time period, then we don't have to care about that one. Also, we can think that there is also a mismatch between expected inflation because we defined here already something about inflation and we are using here a different inflation. So is there a serious difference? Because obviously the data source is the same thing, just maybe ECB was updating the data set. That's the most recent. Oh, inflation expectations are declining nicely. Okay, so whatever. So in this case, let's not care about this kind of a discrepancy because we downloaded this data months earlier and since then inflation expectations at the ECB decreased, especially for this year ahead. So yeah. Also last time we generated all the data, so now we just have to say that okay, what happens with profitability. So insert nice line diagram. Maybe one of them should be dotted. In this case we can see the lack of overlay. And the other one should have different dots. So they are absolutely. So profit of the year, they are ridiculously the same. So we can see that, yeah, maybe we should highlight the difference. No, it's good. So the difference between current and worst case scenarios are highly marginal. Let's just take the difference. Let's take the absolute value of the difference. So what is the in actual money? Yeah, this is quite marginal. So we are talking about 30 million. Okay. I will leave it here because I was talking about it, so let's not change this one. Also, let's convert them to percentages. So they are nice zeros. Okay. And if we are checking the same thing, okay, this is the politician solution, so let's use 0 as a minimum. Or maybe we can, it's not politician solution because we are saying that, okay, let's compare everything to the original setup. So maybe instead of using 0 as minimum, we can use the baseline scenario. which can be at least, we know that, okay, this is the original value and this is what we are able to achieve in terms of value increase. So, okay, value, share value. Reference. Yeah. Moderate. Come on, now we are talking about nearly 200 euros in share price, so that's not marginal. And also but the probability of default is affected by 0.4%, so we can say that yes, it's not affected. So now let's just copy these beauties here. Profit of the year, yeah, parallel lines. Share value, yay, bigger. And bless you. Okay, now we have to do some magic also here to make them, no. We have to make them visible. That's the suffering from success scenario when we are so good that we are not affected by just increasing interest rates at all. Or hopefully I did not made any copy and paste mistake, and that's the reason why the data is not changing, but yeah. Okay, so now we are able to catch up a bit everything what we done last time. So yesterday we were talking about fancy stuff, so how can we decompose, so how can we make decomposition for bond yields, but after that this was not this. The duration was much more interesting. So because still we were not defining completely well how our bond behaves. Just we were saying that, oh, let's generate some kind of yields which can be assumed to be used as interest payments, which is a bit sketchy, but for simulation purposes and for sensitivity analysis we can say that we can live with that. But now let's see that what happens. So can we calibrate this bond yields to be better, or at least the interest payments of the bond and all the other stuff here. So practically what I would like to calculate today is duration. We will check different setups for duration, and also we will see that in this case how the bond price will react on any kind of change in the yield curve, because this is much more important. This can be much more important for us if we have to sell the bonds, and also we can see that we should calculate also convexity, because it's also nice, and we can see that we are able to do both things if we can success. So what kind of ingredients do we need for cooking? Then obviously we need the following data. So let's create a new. Oh no! Before of that we need a concluding remark here. So practically company is not affected, even by double. No, 1B. Yeah, doubled. Yeah. Oh, come on. Now we can start a new. Affected. So we are always using the word or term of affected when some variable is affected by other variable. So yeah, it's not affected. I don't know why, but they are not. We are always using this kind of a term. Okay, so let's use heading, subheading, because still we are in the field of bond yields, or at least bonds. So duration and convexity. Bond price and yield changes. So first of all we need to calibrate. So let's go back to the already saturated interest spreadsheet, and let's add additional tables. And what we need here, not here, here, is that, okay, what is the coupon payment? And we, or at least things can be easier if we are using a fixed coupon payment, because in this case the present value calculations will be not problemous. So we should come up with something which can be reliable. So since we were able to have these tests here and there, 5% can be reasonable, because if we are, or maybe 4%. Let's use 4%. We don't want to give so much money. So. 204. Okay, face value for each bond 100. We don't want to complicate things, because at the end of the day it doesn't matter, just we need it for calculations. So yeah, it could be 1. Also, yield of the bond with continuous compounding is this fixed number. Obviously we don't have a fixed number here, we have everything for years. So 0.5. So then our beautiful yield should come from here. Tap. And we should divide it by 100, because it will be easier. And also should highlight it that this is a calculated data, is coming from somewhere. Then okay, coupon payments are made every 6 months. Let's also define 2 scenarios. So which one is better for us, if we have we are paying in every 6 months or 1 year, because okay, so every time, and after that we will compare it to 1 year. In this case we don't have to change so many things, so it will be easier to make any analysis. Hopefully. Or maybe we don't want to, because in this case we should split this thing up to let's have it only one analysis for 1 year, because it will be already tricky. So okay, so this is time. Okay, now we need the cash flows in euros, let's say. And now we can say that, okay, 100 multiplied by 0.1, so the coupon bond, which is this one. And after that we don't have to do anything because we are using years. And also, maybe if we are allowing it to change in the future, then it's easier to at the face value. Let's no. Let's fix the face value. But we know that in the last year we have to repay this one as well, so 4. Then next thing, we have to calculate the present value. Present value of CF. Then obviously we have to use EXP and the multiplication of the yield multiplied by the time component, and yeah, this is minus. Yeah, because otherwise it will be strange. It would increase instead of decreasing. So okay, now we have the present value for the cash flow. Now we need the weight. Okay, in this case we have to say that, okay, what is the share of, we did the total. So sum. Okay, so what is the share of this kind of cash flow from this total? Then we should use the dollar mark, because otherwise it will go sideways. And then just for carefulness, let's calculate the sum of the weight. It's cool. And then if we are doing the weight multiplied by time, then we will see that, yeah, this thing supposed to, it will increase here because this is one multiplier. Okay, so and if we are summing this thing up, then this will be duration. Okay, we have a beautiful number here. What does it mean? It means years, but practically it means the sensitivity of the bond towards year changes. So let's see what happens with the bond price. And now let's use different bond prices. So what happens if you are able to sell our bond at 100%, 90%, Okay, this is too much. 95%, 90%, 55% and 80%. So that's the actual bond price, and okay, and then we have the duration. So after that we just have to say that, yeah, the bond yield increases by some basis points. So just yield increase. Unfortunately, in this case we are not able to just 0.1%. come on, we can do it better. So we can see that it's practically doubling itself, so 1%, not 0.1. And then let's roll everything through here, and after that we can see that new bond price, or we should highlight also new bond price. Okay, so now we can say that this thing multiplied by the face value is fixed. This is what is happening here, but this should be minus, so it's a negative number. We should not forget it, because otherwise we will have really strange data. Then we have to multiply it with the duration. This is also a fixed number. Then it's multiplied with the increase in the yield, so 1%, and then we have something like this. But so we should add this to the original bond. Oh, that's why it was stupid to say things like this, because now I just overcomplicated. But okay, so plus this number is multiplying this number, and this one is fixed, because now we can see the new bond price. Yeah. So are they in linear relationship? Yeah, they are not, because yeah.
Can you go back to the PPT?
Yeah.
The 94.213 in the table.
Yeah.
6, let's see. No.
Huh?
26. Okay.
So we were getting this data.
So the total value of PV.
Yeah.
That we used.
Sorry.
The B is the total value of PV. The bond price.
Oh yes, you are right. Yeah. Okay. It's absolutely right.
So
Yeah. So I cannot do this. Yeah. Oh. Then. Sad. Yeah. It's no, and it's not a percentage anymore. Oh my. Format says number. Yeah. Here we increase 1%, and now I should remove all this rubbish what I was generating here. So Yeah, B3 is eliminated, and also B3 is eliminated from here. The rest must be okay because, yeah. But now we can see what happens if we are increasing the yield further. So practically you save the day, because in this case we can see that 2%, 3%, 5%. Because now if we are just, instead of fixing the other one, then we are fixing this one. Then we can see that this one will nicely increase. So at the end of the day, still I can make some line here. So delta and also duration is always following some kind of a linear trend, what we can see here. So yeah, it's not changing dramatically, but now let's add further things. So this is the so convexity. Oh, this will be so good. So let's start to build up also in pieces. So because practically we just have to take the multiplication of the 0.5, so the weight multiplied by the square of the time, and just we have to add them up as a sum. So yeah, okay, so wait, here we are, and then it's multiplied by time, which is quite simple for us. No, yes. Okay. Then we just have to sum it up. And now we just have to add this back. So bond increase will be the same thing. New bond price under convexity rules will be the following. So minus this number, and we know that this was coming from the present value. So yep. And this is negative. Then there is this 2 point something, which is coming from duration. Yeah. No. Ah. Okay, I should use mouse. Okay, so duration is there. Then 0.2. Where is this come from?
The individual.
Yes, the yield. Yes, yield. Obviously, because this is what we did last time. And plus all the squares. So time again multiplied by convexity. You just one dot is missing. This is not thousands, this is
And the present value.
7 points, yeah. And also the present value, yes, you're right. So bond price added, then convexity, then time squares. Okay, so we have to fix things. So first of all, G7 must be fixed because it's just one number. G9 is also just one number. Sorry, Yeah, this is we change. B1 we also change. G7 is fixed, and U will be fixed as well. So everything in G's must be fixed, the rest is not. No. That is something. Okay, one big minus at the beginning, one plus in the end. Square is done.
Sorry, what is the percentage change? What are we using?
The percentage change is just 1%.
Okay, that's it. So
So
it will be 0.01.
yeah, so it's definitely not good what we can see here. And after that, things are even more messy. So okay, the G7 bond price is okay because we know that the also duration is appropriate. We don't have to decrease it anyhow. Then we have B12, which is the yield increase here, so we can see that it's also high. Then there is a plus with B. Yes, and the time we had to start with the time, so it's good. No, I realized what happened here. I used B1 here instead of the yield increase. Yeah, so it's B12. So that was one mistake, but it's still not. Oh, it's big enough because yes, the other should be compensated. Okay, so that was all. What I was making a mistake, yeah, because we had always huge positive numbers, so that's why the second half had to have an issue. Okay, but still we have to add it to the past bond price, so bond price, you are the bond price here, so let's add it because in this case we can already see not just the change, not the delta, but yeah. So, wow, that's not good. I can understand that this one is decreasing, but why do you start to increase after that? Ta-da, ta-da, ta-da. Right now we have a really strange but I cannot see that it's a bug. 5% bond increase. Why are you increasing here? Okay, I fixed the bond price, so it cannot be a problem. Convexity, just we are moving this sideways and it was moving sideways. So this is supposed to be a result, not a bug. It is sensitivity analysis. Okay, if I'm able to find the reason, then we will resolve it, but right now I cannot see. Also, we should think about that what can happen if we are using different coupon payments. So what happens if we are trying to introduce, just we cannot, can we use this thing? So let's use floating coupon rates. Yes. Now it's much better. Because in this case we are always just saying that we are paying whatever is happening at the yield curve and doesn't matter what. And the bond price is still okay. Or what happens if we are moving to the worst case scenario? We are paying a lot. And yes, obviously we are paying much more than the market yield, so in this case they should be the same as well here. So we should move this upwards as well. So after that we can see that if we are in a high yield situation, then even if yields are increasing further and further, then bond price will decrease a lot. So now we just get 80% of the face value or pair value under this linear growth term, while we had it was also less than 80%, so we can see that practically doesn't matter in this case when we are just saying that okay, the whole yield structure is variable, we are not paying fixed coupons at all, just what is on the market. In this case the bond price, for them it will be highly neutral, what we have here. So I think we can use this. Or bond. Always pays us floating coupon interest following the triple B rated yields. This is not the cheapest solution, but yeah, why not? And we could still say that we could provide some premium, but why to provide premium if we are in this category? So it's not we are already above the benchmarks practically, so we are paying the risk premium here at this segment, so we don't need any further increase in the coupon payments. Flowing yields. And in this case we just have to say that okay, duration, yields and pays interest once in a year. This one is good because in this case if you have to do coupon payments this way, so we are following the yield curve, then this will create the most simplest interest payment on debt for us, because what are you? Yeah, paid interest. So in this case the interest payments will mimic yield curve, and this was my objective, because for simulation purposes it's good. Okay, so duration will be what? This one? Yeah, that's fine. And decimal points. And the convexity is this other number. No. Just the number without any further formatting, because it's still in years, or yeah, it's years. Year squared. Or and one thing was still missing. My bond prices. This. Right now. Time of the issuance. Therefore, the bond the following will be the following. Means that line in this case, let's so in this case, this way, investors are informed about the use of bond. Because practically for us it doesn't matter, so we are selling it anyways at this price, and after that we can live happily. So even we are earning more money, so we could still say that if we are selling it at not 100 but 102 because we are overshooting, then we should increase the cash reserves more, but let's keep it that way. So you don't want to overcomplicate the Excel sheet because it's already somewhat overcomplicated already. But we should have here more money, not just this 200, but additional 2 point something. So okay, we already have this 2 point something here because we had this small cash reserve, so we can say that yeah, it's there. Okay, next thing. I think we went through all the possibilities of dealing with bonds, so now we need the next beautiful component. This is the leaseback contract. And it's a heading 1. And maybe we need a B lease, because we have to calibrate everything here. So I can close this down. Okay, let's save it. Yeah, because I added the modified the 0 here. Then requirements or topics? Topics. Where we got the lecture notes with financial lease, pricing a lease. So here we need several information. So first of all, okay, we have the lease fee equation here, but before of that we need R. So we need an interest rate, a discount rate, let's say discount rate. And the discount rate must be constructed from different components. So let's start the work. Discount rate for the lease contract, so 0, 1, 2, 3, 4, and they are referring on different things. Yeah, so long run funding, so how can a leasing company fund itself on the long run? Obviously we should look for some kind of benchmark interest rate. So let's go asset classes, fixed incomes, bonds. It would be nice to have also bank bonds, because if you are just going to money markets, so we have bonds only. Bonds, corporate. Then you should do something, yes. Okay, France. In this case it's quite simple, so let's assume several things. So first of all, the leasing company is single A rated, and also we can say that this will be real estate business, so at least we are signing a contract for 20 years. We can check this easily because yeah, so this is the another science agreement with SpaceX for use of the historic launch pad. So practically they tear down everything and they rebuild their own stuff. 20-year agreement. So we can say that, okay, funding is for 20 years. So In this case, long-term funding will follow the yield curve here. So for singular rated company, and also we don't have data for 20 years in the AA, so this is what we have. We should enjoy this. Okay, so this is the long-term funding part. Then we should go next thing. Okay, let's keep this because maybe we can decide this later on. Then let's go back to the equation. So interest premium 1 depends on the maturity and additional down payments. Here we have no idea about this, so let's say it's 0%. We are not able to calibrate this one. Interest premium 2 is defined by commission of the leasing company. Obviously they have to leave for something, so let's say 2%, because if it will be too high, then we will decrease it to 1%. But let's see. Let's start with 2%. Interest premium 3 represents partner risk and the volatility of asset price volatility, so partner risk. We have no idea about asset price volatility, so we just have to stick with this one, and this is what we should generate. So for partner risk, we must use this table. So we need the default rate in the industry. We need time to default. I don't want this special formatting, so let's... But I used just... No, that's just not the numbers. Okay. Now let's type it. Okay, default rate, time to default, and there is no other issue. So now let's see annual global corporate study. So they are always publishing it from the last year, and luckily it's always available if we are registering, so not this website. Yes. No, not this one. This is only from 2020. 21. Then we should use a 2021. So they are selling it for money. Come on. Okay, then. I'm not sure about the level of legality that we are using this website, but I have no idea what is this website. So Google was providing the data, so let's use it mindlessly. Then we should go down to the specific industrial part, which is not aggregated at all, and we can see there are. So if you are interested in the default stories, then also all the globally important defaults are mentioned here with all the category of the company as well. So if you are writing a thesis in this topic, then it can be good for you. Okay, and we were able to find the time to default from original rating grouped by industry. No, Time to default from original ratings grouped by industry, but this is the other version, so this is what we need here. So we are in the case of aerospace and other things here. Average years to default, median years to default. Obviously this is standard deviation, so we don't have to use this. So which one should we use? In this case the smaller one, because in this case this is the more conservative approach. This provides the highest number at the end of the day, so time to default. You can go down within 1.5 a year. Usually they are surviving longer, but okay. Let's see what happens if we are using the average. Then corporate default rates by industry. This is the default rate, and also I prefer to use the weighted average because in this case it contains 3 decades long data. And also here we can see that it's 2% of the companies are defaulting, because this is just biased from year to year, so this one is also more reliable because this is much bigger. We could say median, yes, but weighted average, they are weighting also with the value of the company or size of the company. So okay, that would be overkill to say that let's use maximum, so this one is still reliable. 2. Okay, for median it's 0.39. Yes, I'm collecting both of them, that if one number will be ridiculously high, then still we can say that we will choose the other. Okay, so we were able to grab the data, so now we just have to say that okay, let's calculate the return here. So default rate divided by time to default. And then we don't have to multiply it with months because we will just calculate with annual fees, so we don't have to deal with that one. Multiplier due to capital reduction. This was set to 2 in at the company. So okay, and now we just have to divide this by 100. So this can be somewhere between maybe add some decimals. So it can be somewhere between 0.75% or 2.66%. So let's use the highest value. Also partner risk, or after partner risk, then additional services. Luckily we don't have any additional services, we are just providing the land usage, and we are not going there to mow the lawn or I don't know what we can do with the launch pad. So yeah, let's keep it simple. So let's sum these things up. Hmm, 8%. It's a bit more expensive. So now we should calculate the lease fee. Do we have any? Oh yes, we have the asset price. And we have the residual value. Yeah. And also we have the time. It's for 20 years. And nothing more. Yeah. So this is what we are looking for. Okay, so in the asset price, still we need 200. So let's keep it the same. And also we can see that if we are checking properties, so we have an unknown amount of properties, but it's way above 200. So let's say that 200 is the value of the asset. Okay, so residual value, it can be, so at least in case of US GAAP, they are saying that 25% should be the residual value. So let's say that we are following this structure here. So obviously we are talking about land. So land is not affected by depreciation in accounting, at least as I know. It's not affected yet because it would be really strange. So residual value, the concept in this case, it's quite sketchy because maybe we can say that okay, after 20 years you have to change the launchpad anyways. So you have to remove a lot of equipment which are rusty and not usable anymore. So it can have extra expenditure. So that's why residual value of the land can go down. Otherwise, it's really hard to define or give a meaning to residual value in terms of a land. But, okay, so we need something, so that's why. Okay, we start with two brackets, asset price, this one multiplied by 1 minus residual value. In this case, this should be a percentage, so we will compensate it because otherwise it would be business. Then multiplied 0.9 and then divided by the annuity component. So minus 1 plus this thing minus time, which is 20 years, and we just one of them. Okay, this is the upper level, close down, okay, and divided by R. Then let's close the bracket, and then what? What are you trying to? Okay, so this one is residual value percentage. So it's not an actual value, it's just percent. But we can see that we have to pay such amount of money. So if we just have to convert it to a percentage, so let's compare it with the asset price. So 7.2% is what we should pay, which is related to this money. So yeah, now we should integrate this. Okay, so in this case I think that we should create another save file from this one because I have to dig in to here, but also at the same time I should eliminate the interest payment on that, so that would change so many things here. So let's create save as So first save this one. Okay, then save as. In the MATLAB folder, exposure option, interest, lease. Sooner or later, before we are reaching 1 kilometer file name, semester will end. So okay, so this is the lease fee. Let's use a beautiful blue color. Oh, we used already blue color. So red. Yeah, we did not use red yet. Okay, financial lease. We should just add this one. And we should fix it because this is happening for each year. And then we should add also the but now we don't have to pay interest anymore, so this one will be zeroed. So we can zero this out, but also and also this is funny because okay, we sold the property, so it should be removed from the assets, but after that, since we are leasing it back, then it's reappearing in the assets. So practically, property is not affected because we just removed and reinstated here the property, so we don't have to modify the asset side. What we needed to modify is the financial lease must or had to be included. And now let's see that how our operations are affected by this. So first of all, what happened with profit? Copy here, financial lease. Was it changing? Not so much. Or at least I cannot see that it creates any drastical movement in the profit. Let's see. No. Let's see the value. Actually, it's absolutely somewhere in between, and we were using the strictest level to determine, so we have high commission rate, we have high partner risk consideration here, so we cannot say that we try to make everything more easier to highlight. These, in many cases, practically these should be more expensive, so it has absolutely no influence on the default probability as well. Okay, so let's add this additional data. Yeah. Now we have 3 lines at the same space, so cool. Is this a good way to make this visible? But I cannot rescale it because okay, so I should leave it that way. Also, in case of share value, we can add also edit. 50, touch. And don't you need names? No. Cancel. Why are you not visible? Okay, select data, edit. We are doing the same thing, just in this case, it will be happy. Value, and also we know that the minimum value will be the original here. And let's color this to red. Here, red. Okay. Probability of default. Then we can say that nada is changed, so utterly the same. Okay. Oh my god. Okay, so time is up. So next week we will add this also to the menu, and after that we have still some job to do. New shares must be issued. Yes, obviously. This will be also fun to see. I don't know, maybe we will delete this because we can say that 8.4% of funding costs. Yeah, so even the lease is cheaper than this one. So, but it will be really easy to test because we just have to add it to the interest payment. So. Okay, so that's all for today.